Iron ore is at $106 a ton. Analysts didn't see that coming. And yet, the three largest Australian iron ore miners all finished March in the red. BHP fell 13.7% over the month. Rio Tinto dropped 3.5%. Fortescue gave back 3.9%. That divergence, a commodity strengthening while the companies extracting it sell off, is not a contradiction. It's a signal worth unpacking. The surface explanation is the Iran conflict. When fighting escalated in early March, commodity markets rattled across the board. Copper fell 8%, closing March at $12,225 per ton. Oil uncertainty spiked, and investors sold mining tickers broadly, treating them as geopolitical proxies, rather than reading the fundamentals underneath. MPC Markets described it plainly. The market is selling the ticker, not the fundamentals. BHP's output routes run predominantly to Asia, not through the Strait of Hormuz. The conflict's direct operational impact on Australian iron ore exports is limited. But the share price damage was done anyway. BHP shed more than $8 a share from its February close of $58.41 to end March at $50.39. Even after accounting for its $1.04 fully franked dividend paid on March 26th, investors holding through the month lost 12%. That context matters because BHP's underlying numbers tell a different story. In the first half of fiscal year 2026, group revenue rose 11% year-on-year. Profit from operations climbed 34%. The dividend came in above expectations. And for the first time in BHP's modern corporate history, copper delivered the majority of earnings, not iron ore. That structural shift in BHP's earnings composition is something many investors are still pricing through the old lens. Rio Tinto, meanwhile, was dealing with a more immediate operational disruption. Cyclones in February and March, including Tropical Cyclone Narelle, hit the Pilbara hard enough to deny the company the opportunity to ship approximately 8 million tons of iron ore. The lost revenue exceeded $1 billion. A 10% productivity hit to its flagship Australian iron ore division in a single quarter is not a minor footnote. And yet Rio Tinto maintained full-year shipment guidance. That guidance hold is the detail most commentary glossed over. Absorbing an 8 million ton shortfall and still keeping the annual target intact implies either significant operational buffer, planned catch-up capacity, or management confidence that the Pilbara's output cadence recovers quickly, possibly all three. The share price rose on the guidance confirmation, a market read that the disruption was temporary, not structural. Here is the part of this picture that is underweighted in current analysis. The iron ore price reaching $106 per ton was not driven by a demand surge from China alone. Part of the support is coming from a cost-push dynamic on the supply side. Diesel prices are rising. Fuel availability is increasingly uncertain in an environment where conflict disrupts global energy logistics. For iron ore producers operating large open pit mines with significant diesel consumption, higher fuel costs translate directly into higher all-in sustaining costs. That compresses margins at the operational level, but it also prices out higher-cost marginal producers globally. When marginal supply retreats, the floor under the iron ore price rises. The commodity market is partly pricing that in already.
The second underappreciated factor involves Africa. Simandou, the massive Guinean iron ore project that has been in development for years, is beginning to enter the longer-term supply calculus. The conventional read is that Simandou represents future competition for Australian producers, a volume overhang that will eventually pressure the iron ore price. That framing is not wrong, but Rio Tinto is a major shareholder in Simandou. The competitive threat from African supply is partially internalized within Rio Tinto's own asset base. The company is not purely a victim of Simandou's ramp-up. It is a beneficiary, too. Rio Tinto's portfolio construction also deserves more credit than the current price implies. The aluminum exposure, often treated as secondary, has become relevant in a different way. The Middle East produces around 9% of global aluminum supply. Recent Iranian strikes hit Aluminum Bahrain, one of the world's largest smelters. A separate large UAE producer was also struck. Aluminum prices jumped 6% in response. Rio Tinto's aluminum operations are positioned to absorb supply gaps that Middle East disruption creates, a role that compounds over quarters, not days. Add copper and lithium to the picture. Rio Tinto has spent several years deliberately building exposure to electrification commodities. That positioning looked premature through 2024 and early 2025, as Western governments pulled back on EV mandates and renewable energy targets.
But geopolitical volatility has a way of reasserting the underlying case for energy independence. When fuel supply chains become uncertain and diesel costs rise, the structural argument for electrification strengthens without needing any policy catalyst to drive it. BHP is running the same playbook, with its own copper growth concentrated in the Americas. The strategic rationale behind naming Brandon Craig, who led the Americas business, as the incoming CEO effective July 1. The choice signals where BHP sees its next decade of earnings growth coming from. So, what are the two paths from here? The constructive scenario rests on a few conditions holding simultaneously. The Iran conflict remains regionally contained, meaning Australian export routes to Asia stay unaffected. Iron ore demand from Chinese steel production holds steady or recovers through the second half of the year. Diesel cost pressures continue to suppress marginal global iron ore supply, keeping the price floor elevated. In that environment, $106 per ton iron ore, combined with recovering share prices in BHP and Rio Tinto, produces a re-rating that rewards investors who bought the March weakness. Rio Tinto's guidance hold and BHP's strong H1 numbers give that scenario a credible base. The more cautious path opens if the conflict broadens. Diesel shortages materialize operationally rather than just as cost pressure, and Chinese steel demand disappoints through mid-year. In that case, the share price declines were not overreactions. They were early reads on genuine earnings risk. BHP's copper pivot provides some cushion, but iron ore remains large enough in both companies' revenue mix that a sustained price retreat would show up in earnings quickly. The evidence leans toward the constructive scenario, but only if Australian export logistics stay insulated from Middle East disruption. The commodity price is already telling that story. The share prices haven't caught up yet.